BigBear AI stock is trading at $4.14 right now, moving flat with a 0% change in today's regular trading session, holding steady after its recent swings between $4 and $4.22. While that tight daily range might look quiet on the surface, what the broader market is completely missing here is the massive divergence between how retail investors view this name and how institutional players are treating its growing backlog. The casual trader looking at a retail application like the Robinhood app or browsing social media forums often buckets BigBear AI into the same volatile, speculative pile as consumer-facing software plays. But if you look behind the scenes at actual federal contract flows and the defense procurement pipeline, a completely different narrative emerges. There is a structural shift happening in how the government awards contracts to boutique data firms, and BigBear AI is quietly locking in sticky, long-term government obligations that do not care about the hype cycles of Wall Street. When most people pull up BigBear AI on online investing platforms, they expect a high-flying software-as-a-service provider that should be growing revenue at 50% a year. That is the common expectation. The reality, however, is that this company functions far more like a specialized defense contractor that happens to use algorithmic frameworks. Investors get frustrated when they see a quarterly revenue figure like $34.44 million, thinking it should be scaling like consumer software. But the real insight is in the unbilled backlog, which recently surged with over $60 million in national security contracts alone. This creates a fascinating contradiction. The retail crowd buys and sells the stock based on generic tech momentum, while institutional clearinghouses look at the defense budget allocations. This tension between what retail investors expect a software company to look like and what a defense tech hybrid actually operates like is exactly why the stock sees such massive, sudden volume spikes on seemingly unrelated news. Let's look closely at the immediate trading dynamics and the market pressures that are forcing this asset around. Over the past year, the stock has carved out a wide, volatile range between $3.01 and $9.39. That is a massive spread for a company with a market capitalization hovering right around $1.94 billion. When you see a beta of over 3, it tells you that the stock reacts violently to sector momentum. Just recently, we saw the stock surge on heavy volume simply because broader tech names like Snowflake posted numbers, or because other enterprise tech platforms signed cloud infrastructure deals. Traders utilizing a self-investing strategy often see this sympathy momentum and pile into the equity, driving intraday volumes well past 26 million shares. But that short-term volatility masks the structural reality of their institutional support. BigBear AI has historically been heavily backed by AE Industrial Partners, a private equity firm deeply embedded in national security, aerospace, and defense logistics. This means the floating supply of shares is subject to different institutional pressures than your typical tech startup. When large private equity groups hold major blocks, the public float reacts far more violently to small shifts in retail sentiment, leading to the rapid, aggressive short squeezes and sudden pullbacks we observe on the daily chart. If we look at the core mechanics of online investment platforms and how retail flows impact this stock, it becomes clear that many traders are using individual brokerage accounts to trade the volatility rather than investing in the underlying corporate thesis. On platforms like SoFi Invest or through various self-investing apps, BigBear AI frequently tops the lists of trending low-price tech equities. This retail concentration means that macro pressures like an unexpected inflation print or a shift in Federal Reserve interest rate policy can cause quick liquidations as retail portfolios shed high beta assets first. Conversely, when retail risk appetite returns to the technology sector, capital flows back into these low-price names rapidly. But serious capital allocators, the ones using advanced tools on an interactive broker's platform or managing substantial wealth through Fidelity investments, look past the daily retail noise. They are analyzing the gross margins, which currently require heavy service delivery and consulting hours to fulfill. In their latest financial report for the first quarter of 26, the company reported a net operating loss of $23.04 million on that $34 million in revenue. That's because integrating fragmented data for federal defense intelligence is highly labor-intensive. It is not an automated plug-and-play app you download on your phone. It requires deep systems engineering, which compresses near-term margins and tests the patience of short-term traders. Comment below how many shares of BigBear AI you currently hold in your portfolio right now, or if you're just watching it from the sidelines. To truly understand why the stock behaves this way, we have to examine what BigBear AI actually does from a functional business perspective. Founded back in 1988 and headquartered out of McLean, Virginia, the company was built from the ground up to serve high-consequence decision environments. They operate in 3 core markets, which are global supply chains, autonomous systems, and cyber defense. Instead of building general-purpose language models, they specialize in what they call decision-dominant software. Their proprietary platform is broken down into 3 composable steps, which are observe, orient, and dominate. In practice, this means they take incredibly messy, imperfect data environments, like real-time inventory tracking across global military supply lines, and use machine learning to build predictive courses of action. They also run the Ask Sage platform, a generative system designed for secure deployment across thousands of government teams. This is a business model built on clearing security clearances and navigating complex government procurement regulations, which takes years to establish.
Their acquisition of firms like Panjam has expanded their footprint into digital identity and biometrics for global trade and travel security. This legacy explains why their customer list includes the United States intelligence community, the Department of Defense, and federal homeland security agencies. It's a business built on deeply entrenched government relationships, making their revenue stream incredibly secure once an active project begins, even if the timeline to secure those contracts is agonizingly slow for Wall Street. Looking forward, the future outlook for BigBear AI hinges entirely on whether they can successfully transition from a labor-heavy services contractor into a scalable software licensing model. If you look at options chains and long-term positioning on sophisticated investing sites, institutional traders are preparing for two distinct scenarios. The bullish catalyst relies heavily on their international commercial expansion, such as their recent deployment of an AI-powered supply chain security platform in Panama's Dry Canal. If BigBear AI can prove that its logistics software can be commercialized by private shipping conglomerates, manufacturing plants, and healthcare systems without requiring massive teams of implementation engineering, their gross margins will expand rapidly. This shift would cause a fundamental re-rating of the stock, forcing analysts to value it as a scalable software firm rather than a defense consultancy. On the flip side, the primary risk remains their high operational cash burn and their dependency on lumpy federal budget cycles. If Congress delays defense appropriations or if government procurement cycles slow down, BigBear AI faces severe revenue stagnation while their fixed engineering costs remain high. This is the exact expectation versus reality dynamic that will dictate where this stock trades over the next 12 to 18 months. When we look across the broader landscape of modern online investing, from robo-advisory tools like Schwab Intelligent Portfolios to active trading systems on a Fidelity brokerage account, managing a position in a specialized name like BigBear AI requires a clear understanding of its unique position. It sits right at the turbulent intersection of public venture capital, defense contracting, and enterprise analytics. The central insight here is that Wall Street's expectation of standard tech stock behavior is constantly colliding with the slow, deliberate reality of federal defense spending. While retail momentum will continue to drive sharp short-term daily swings that flash across popular trading apps, the long-term value of the company will be decided by its ability to turn its growing contract backlog into positive net income. For investors tracking this asset, watching the commercial customer acquisition rate and the stabilization of operating expenses will give you the real answer long before it shows up in a headline. Keeping that structural contrast in mind is the only way to navigate the extreme volatility of this unique defense tech equity without getting caught in the retail noise.